Hello friends, Namaskar. Welcome all of you to my channel. Today let's discuss about the theories and the models of the behavioral finance. In my last video related to uh, behavioral factors that causes investors took decisions not rationally. Today let's discuss about what are the basic concept which could explain about the behavioral finance friends. Based on this background, let's move to the discussion on the its introduction first of all. That's a traditional or standard finance theory. That's arbitrage pricing theory as discussed by Ross 1976. Similarly, capital structure theory discussed by Modigliani and the Miller in 1958. Modern portfolio theory as discussed by Markowitz in 1952. Similarly, capital asset pricing theory Sarpe in 1964. Dividend irrelevance theory again discussed by the Miller and Modigliani in 1961. While dividend relevance theory, that's a Linter 1956, and the option pricing theory, Black, Scuse, and the Morton in 1973. Friends, there are so many. You can say that numerous theories of under the standard finance. You can say that corporate finance. Investment. But these all theories confined within the scope of rational analysis, friends. So that means investors think and behave rationally. That's assume that. However, friends, traditional finance theories have been criticized by the various behaviorists and psychologists since the investor usually don't think and behave rationally. Okay, so we can say that there are many observed market movement. That's market anomalies that are not explained by the arguments of efficient market hypothesis as discussed by Pharma. While the behavioral finance has been introduced to explain the market anomalies and understand the investor psychology, friends. Okay. Now let's move to the what are the main theories under the behavioral finance. Broadly, we can say that behavioral finance is mainly based on the two theories. That's limits of arbitrage and the investor sentiments. Now let's discuss about the main theories under behavioral finance. First one is the prospect theory, under which is all about investor risk aversion increases with your wealth but at the decreasing rate. And next thing that we need to understand here, that is the common emotions in the human beings, that is the fear. So this is the loss aversion and the sunk cost theory as discussed by Thaler 1980 about the sunk cost theory. And next one is that of the greed, that is the status quo bias and endowment effect as discussed by Daniel and the Thaler in 1991. Now the question is about how investor makes decisions when they are guided by these two emotions under uncertainty, friends. So again, when we discuss about the prospect theory, that's all about that means investor feel more strongly about the pain from loss than that of pleasure from equal gain, we can say that. And consequently their value function appears concave in gains and concave in losses, with the bend at the reference point which separate the gains from the loss region, that you could see this in this picture too. So this is all about we could see, friends, we have a right side is the gain and the left side is the loss. Okay, so this is the when we have a gain of just $50 here, so that means 50 gain gives less joy as compared to the pain from 50 loss. And again, when we at the same time when we have a loss of 50, so that means you could see, that's why it has been discussed here, their value function appear concave in gain and convex in losses. So this is that means we react more when we have a losses. That is the main point that you need to understand here. Now let's talk about what about the, friends, behavioral capitalist processing theory as discussed by Safrin and Statman 1994. The behavioral capitalist pricing theory is based on the, no doubt, that is the capitalist pricing theory which is based on theoretical and the rational, while behavioral capitalistic processing theory incorporate the psychological biases, that is the like your overconfidence, hoard, hoarding behavior, yeah, encouraging bias, availability, heuristics, framing effect, like that. Last time I discussed about the 10 multiple choices questions from the biases only. Now today I'm discussing about this theoretical part of behavioral finance, friends. So it recognizes the humans are not always logical and thus offering more realistic view by explaining the market anomalies. And next one that we need to understand here, it's focus on the one is the market noise trader, as discussed by Albert 1985 and the Black even the 1986. That means market noise trader means those investors who make buy and sell decision in the financial markets based on the non-fundamental factors, friends. Like your non-fundamental factor means is the behavioral factors, we can say that. Yeah, some of the things like your emotions, humor, yeah, hype, hoarding, like a following crowd. This is called, we say that, friends, market noise trader. And next one is that information trader, often called insider, we say that, and who buy or sell company securities using the secret, crucial or non public data, or you can say that private data, like your upcoming earnings, merger, acquisition announcement, like that. Before publishing information, if someone know about the information and they just based on that private information, then when they react, then that is all about, we can say that, information trader, friends. So that anyway, that's insider trading is all about intention is that making the unfair profit, which is the illegal. So we can say that the market is efficient when information traders are dominant in the market, while if the dominant traders are noise traders, then market is inefficient, friends. Now let's talk about what about the behavioral portfolio theory, friends, as discussed by Safrin and Stratman 2000. So that's is the cornerstone of your, we can say that, concept of Markowitz 1952 discuss about the modern portfolio theory. So that's about your efficient frontier. Is a different from basically behavioral portfolio theory is the different than that of mean variance efficient frontier, as discussed by the Markowitz 1952. An optimal portfolio of, that is behavioral BPT here, that is the behavioral portfolio theory, and the CAPM are not the same. And that's why investors think about the expected wealth and when they select the portfolio. And it can be classified into two types, we can say that. One is a single mental account, and next one is that multiple mental account, friends. And their differences are that behavioral portfolio theory is a SA is the, this is the single one, okay, and the investors use a single mental account to manage their portfolio, while in case of behavioral portfolio theory, in case of multiple mental accounts, investors use the several mental accounts to integrate their portfolio. That is the point that you need to understand here. So we can say that investors buy the risk-free investments from the low aspirations mental account, because when you are not going to take the more risks, then in that case you are looking for risk-free investment as a conservative investment investor, we can say that. But at the same time, when you are going to take the more risks, then you try to buy the speculative bonds, for example, for the high aspirations mental account. That is the point, friends. Today I just discussed about the, friends, what are the theories and the models which explain the behavioral finance. So I started with the traditional finance, then I discussed briefly behavioral, that's a perspective theory. Then we also discussed about the, friends, that is the behavioral capitalistic processing theory. Then I discussed about the behavioral portfolio theory, friends. Okay, friends, these are the things that I would like to share today. If you really like this content, please like, subscribe. That is my YouTube channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.